Hey there, folks. Welcome back to another episode of The Property Couch. And have we got a very special episode for you today? We are going to be back in the studio, which we haven't done very often post-pandemic, to have a fireside chat with one of the brightest property tax minds in the country, Ben. We are going to have a lot of fun with this episode. But what else?
Bryce, I'm also going to pick up on the story of a couple of important things. Landlords are definitely still doing it tough. We know tenants are doing it tough, absolutely, but there's certain landlords out there who are doing it tough. So we talk about that in what's making property news. And finally, Bryce, we also are taking a look at the market is showing signs. Green shoots, Bryce. Have we hit the bottom? So I'm going to have a little bit of a chat about that at the end of the show as well. So stick around, folks.
Green shoots. Is that true, folks? We cover a lot in today's episode. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. Welcome back to you too, mate. How are you?
Oh, mate. Lanolin smell, deep heat. Woody season.
Woody season.
Go Pies.
Mate, can you believe it? I'm actually going to your game this week. My son is a Geelong supporter. They're playing you guys. I'm taking a fellow school dad who's a Collingwood supporter. It could go to custard pretty quickly. Could go to custard pretty quickly if your team wins. But looking forward to that. And last week we had Evan Lucas on the podcast, Ben, Mind Over Money, and we got heaps of really great feedback. I got lots of feedback during the week about, the fact that getting your headspace right is pretty much the number one thing you want to do if you want any sort of investing success. So some of the stuff that we talked about, scary, ugly, spend vesting, turning an ugly duckling into a swan. So that was super well received as well, Ben.
Well, it's really simple, Bryce, that if your head's not right, you won't act. So if we can get the mindset in good order, then hopefully that'll lead you through that first stage of taking action, and you'll be thanking yourself in the future for the action you've taken today.
Perhaps your future self will thank you for it, Ben.
Perhaps.
Hey, a couple of things too, just before we get into today's show. Free gifts. If you are listening to this podcast on the date of release, which is Thursday, what's the date today, Ben? I've got to check. Thursday, the 16th of March. You will have until 11:59 tonight to download the free reports, because as soon as the clock strikes midnight, bang, the freeness goes away.
Tick. Take action, people. If you want those free reports, up to 5 of them, then it is the time. Now is the time to act.
Thousands of people have done it. If you want to do it, you've got till 11:59 tonight. Hey, Ben, you had to pick a webinar last night. It is available on demand for those who weren't able to make it. Can you tell everyone what it was about, please?
Yeah, so we were just talking about what's happening in the tenancy reforms around the different countries. And so we had an expert in this area, a lawyer in this area, to talk about tenancies and how we can combat and look at the strategies around the changes in legislation that's happened around the country, with a bit of a focus in on Western Australia, mainly because naturally that state still hasn't made their final decisions. But it's really clear that investors don't like the changes because they're not, coming in droves into the marketplace at the moment. So we just wanted to take a deeper dive on that and sort of some of the strategies in terms of how we can support and the messaging that we want to put out in the community around the value that what property investors bring to the table as well.
Beautiful. And stick around for your What's Making Property News today, because you are actually going to dive into what's going on behind the scenes for property investors. So stick around for that, folks. It's one that you really want to be part of that conversation. And Ben, we've got a very special episode today. You and I caught up with Julia Hartman, who is the founder of BanTACS and got copious amounts of degrees like Bachelor of Business, a Chartered Accountant, a Fellow of the Tax Institute and a Registered Tax Agent, as well as our Chief Tax Advisor here in our business. So we've got this really cool setup today. Props to you. through setting this up, because we decided to get us all in the studio, which we haven't done a lot post-pandemic, Ben, and we sat around and we just riffed it. And it was like three of us were just riffing the idea of the topic that we're talking about today. And our community will be the judge, Ben, but I think it went pretty well.
Yeah, it was great to be on the couch. It was just very calm and casual. It was a really nice fireside chat. I really enjoyed the way in which we just, exchanged ideas, and obviously tapping into the amazing tax mind of Julia was quite incredible. So no, I think it's a great episode, and it's for those people who are watching on YouTube, it's just nice to also not just be an audio file, but also have a little video chat as well. So very, very cool.
What we do know is audio people love audio and video people love video. So most of our audience will still listen to us via audio. But if you want to check it out on our YouTube channel, The Property Couch, you can go and do that. So we're going to get to that shortly. But before we do, the Mindset Minute theme today, Ben, is a story from Charlie Munger. For those people unaware, Charlie Munger is associated business partners with Warren Buffett. What I most love about Charlie Munger is the way that he thinks, right? Everyone loves how Uncle Warren sort of invests, but Uncle Charlie thinks, he synthesizes things down, Ben. I love that, right? Frameworks in his mind. And here's a little story, right? It tells a little story about human nature. One of my favorite stories is about the little boy in Texas. The teacher asked the class, if there are 9 sheep in the pen and one jumps out, how many are left? And everyone got the answer right except this little boy, who said, none of them are left. And the teacher said, you don't understand arithmetic. And he said, no, teacher, you don't understand sheep.
Very good. I like it.
So then you got to think, okay, FOMO, when things are going flying, well, does that resonate when it's in FOMO? What about FOGO, the fear of getting out, Ben, in the tough times? Some people have FOGO. But, over the weekend, the Silicon Valley Bank, one of a couple of banks. And so all the fear was when the markets open on Monday, are they going to have a run on the banks? So they'll need to step in on that. So really the theory here is history doesn't repeat, Ben. Human nature does. So have a little think about that.
That's a piece of gold, Bryce. That is an absolute piece of gold from one of the greats.
So most people think there's only 8 left in the pen, Ben, but those who know human nature go, there are none left. They all jumped out together. So hopefully that landed for you folks. Hopefully that gets you thinking about the current environment that we're in. Stick around to what's making property news. Ben will talk to this very topic in his commentary around a couple of things that are popping up in the market right now. But without any further ado, Ben, you and I had a fireside chat with the one and only Julia Hartman. Let's cut to the conversation we recently had with her. All right, Ben, today we've got a very special guest. We've got Julia Hartman's returning back to the Property Couch. She is our Chief Tax Advisor within the Empower Wealth business. And we thought it'd be really fun to talk about the entities that people buy properties in, the pros and cons.
Yep.
And given the amount of detail and the amount of knowledge that we have with Julia in the room, thought it'd be a good idea just to riff a couple of ideas around the pros and the cons. But first of all, welcome to the Property Couch, Julia.
Thank you, Bryce. Thank you, Ben.
Yeah, it's the biggest question that comes up all the time when people are thinking about, all right, I'm going to invest in property. Then they start thinking about which type of entity or what does it mean for my tax position, all of those other things. So that's why I thought it's a great time to wax lyric on this particular topic.
Now, Ben, you and I have covered this at certain parts of the journey along the 430 plus episodes that we've done, but I thought it would be nice to have a structure like today where we start by saying, well, there's a few myths out there when it comes to asset protection, Julia, and you would have seen many of these over the journey, but I guess from our perspective, Ben, it's the plan is quite simple. It's to accumulate a few properties, plus your principal place of residence,
plus your super,
and combine it with your super, and so that you have the our flagship $2,000 a week. But what hopefully our community of listeners have learned along the journey is there's complexities that come with that. If you have your principal place of residence and you rent it out to someone, it changes the tax treatment. If you're in a particular industry, you might be more litigious than others. So I guess today, Julia, we want to talk about the first myth around entities, and that's the fear that a lot of people have been given through, whether it's a seminar, an online webinar, or whatever it is, that we run this big risk that the assets, if we have them in our own name, we're at a lot of risk. So what are your initial thoughts on that?
I think you've got to evaluate your particular circumstances, and through all of what we're discussing, I want to say not one size fits all. I spoke to a solicitor once and he said basically if you're a landlord and you've done the right thing, you're not ignored things that need doing, you're reasonably safe. We pay a lot in insurance policies to cover ourselves, but of course there's occupations that are fraught with danger, and you hope you have a spouse that doesn't have the same exposure.
Now, Julia, you're the head of the BanTACS group, of which we're a part of, but we know that there are other accounting firms out there that do scare a lot of people around the risk of, they tell a story that this person tripped over the step going into the property and they hurt their knee and there was a $200,000 payout, and so even if you're not in, say, a medical fraternity or a legal area where you might have a higher risk associated with protecting your assets, they prey on these sort of isolated stories to get you to take more complex structures.
Yeah, it's the fear factor, isn't it? I've gone to one of those seminars and I can feel myself churning as I listen to the talk, and I think, what's going on here? I'm being made scared. And look, I'm really worried about saying, look, don't worry about it, because obviously there is an element in there.
Risk there,
but you've got to weigh it up. And as we talk further, we'll talk about the different things you can do, but they're all going to cost you more than just having it in your own name, and there's going to be downsides.
And who's benefiting from it? Like we always talk about, like we are those people who's like, invest in property. Yes, so you're asking a barber for a haircut. We are passionate about investing in property. We put our bias up there and our disclosure up there as well. But the idea that someone who's telling you to actually have these protection layers is actually financially going to benefit from the ongoing fees and charges associated with that structure.
I think that's a good point, Ben, that it's very difficult for people to be able to decipher is the intention of the advice for the person to receive more fees, or is the intention of the advice a reasonable,
honourable?
Is it reasonable? Am I in a highly litigious environment where they're actually looking out for my best interest, and that actually makes sense? Okay, great. Versus the ongoing fees. So I think anecdotally it'd be interesting for you, Julia. In my experience, I've been helping investors buy properties since 1998, so now in the 25th year, and the vast, overwhelming majority of times that I have put a name on a contract, the overwhelming 95+% of the times, it's in an individual name. Now, I have put SMSF on there, I have done it in partnerships, I have done it in trusts, so that I've certainly been exposed to other structures. But Ben, you're in a similar position, but I'd be interested in you, Julia. Of all of the individuals that you've seen invest in property, is there a trend that you've seen on what structure they're in?
Oh, the vast majority would be definitely in their own names, that's for sure. A lot of people acquire properties because it used to be their home too, and you need to have it in your own name to get the main residence exemption. The only other two vehicles, subject to who I was talking to before, I do have one client that's got them in companies before I came along, but other than that, I see discretionary trusts and I see super funds. And discretionary trusts moderately more expensive, super funds are expensive, and both of them have borrowing problems, which I'm sure you guys can talk more about.
So there's around 2.3 million property investors out there at the moment,
give or take,
give or take, and we work full time in this space. And Julia, you've been doing this for many, many years as well. Outside of the seminars that we've been to years ago, where they were, spruiking these horror stories, how many examples have you ever heard of where someone was sued for their property, or sued in their business and they lost those investment properties? Can you recall any stories?
No, I can't recall any stories, and which is not to say it doesn't happen.
Correct,
but
it does happen.
But the fear that is propagated by people is the outlier stories that come into the mainstream and then add some complexity to it. And we're going to go through some pros and cons of each one shortly.
Yep.
But I've been on the side of the fence where there has been I guess, lots of coercion around a particular pathway.
Yep.
And I remember at the time I didn't want to go down that particular pathway because I still firmly believed from my own heart that it was best for people to be in their own name. Now, I can't give advice, and people have got to have their own individual circumstances, but through that anecdotal evidence, through most people being in a non-litigious environment, meant that all of the wonderful benefits that come from investing in your own name, which comes down to tax benefits, comes down to flexibility, which comes down to the amount of options you can have in terms of lending. If you're at fear of asset protection, you will quickly put those to the side and chase that path. But it's really about how often does that fear get realised.
Yeah, that's the agenda that's being portrayed as part of that story. Originally, it was setting up in these fancy tax structures, looking at hybrids, and we're going to go there in a minute. And then it was obviously discretionary because of the asset protection, and then self-managed super funds. All of a sudden, you could leverage and lend and borrow in a self-managed super fund. So the next big trend for selling property was through those types of vehicles, and it's just a really good reminder for everyone that these fads, they do come and go, but ultimately, where's the bulk of the evidence suggests that it's the right way to go. And I think that's probably a perfect segue for us to talk about the different types of structures that you might be able to use, and then sort of talk about the pros and cons and trying to get an idea of who might that suit based on what we learn about that.
So Julia, before we go through the pros and cons of each, let's detail what are the options that people have to purchase investment properties.
So personal name, and that brings in the question of just your name or your spouse's too. Then you've got a discretionary trust, which allows you to choose where you distribute things to, but you can't borrow and claim negative geared. The losses are locked in the trust. Yep. You've got unit trusts where you can borrow to buy the units and possibly negative gear in your own tax return, but you've got to ask why you do it, because you then own those units, so you've got no asset protection because your creditors come along, get the units, they get the house. And the reason you're allowed to claim the interest to buy the units is because you've got a fixed right to the income, and you won't get that deduction. Otherwise, if you've got the fixed right to the income, you don't get the discretion as you go through life. So companies which don't get the 50% capital gains tax discount, that's mainly why they're out of the pool. And you've still got that fixed right because it's the shareholders, so and then super funds, which have great tax concessions, the best asset protection you've got. There's never been a discretionary trust broken down for asset protection, but they tried with a one-tel at one stage. It was attempted. So it's a bit dubious, but supposedly super funds, unless you're a pedophile, I believe now, they're looking at getting at them.
Wow, there we go. Well, and fair enough too, I reckon, just for the record.
A little bit of a little tip that we weren't expecting. So.
And the final one was the hybrid trust as well, which was a combination of discretionary and unit trusts, which we've seen over the journey, promotions of those types of
We're going to spotlight that one, Ben. We're going to come back to that. We're going to spotlight. So let's summarise. You can do companies, you can do it in a self-managed super fund, you can do it in trust. You've got three versions of the trust: unit, discretionary and hybrid. And you can do it in your own name. So we're going to circle back to all of them. But let's start with the company, Julia. If I'm coming to you as a tax advisor, I'm asking you for advice, and Julia, I found this wonderful property over here that I want to buy, and I've always wanted to own it in a company my whole life. What advice are you going to give me, Julia, about whether I should put it in a company?
I'll try and talk you out of it, but I won't be successful. If you are, and it's all about horses for courses, if you are someone that says, I'm never going to sell that property, so I don't care about the capital gains tax discount. I'm in the maximum tax bracket, so I want the rent to only be taxed at 30 cents on the dollar and leave the money in the company to pay down the debt or whatever. You can see how that's working. Because if you take the money out of the company, then you've got to top it up or go for Division 7A loans or anything like that. If you've got the company, you bought 100,000 deposit, you've got 400,000 debt there, and yet somehow it's positively geared, you want to just pay your 30 cents tax so you can pay it off. But that will always come back to bite badly when you sell. So with 50% discount on the capital gain, it's pretty significant in most cases. So I don't, I strongly advise against it. And the only comeback that's been successful in my arguments, because we get out and do the numbers, is that they've said, well, I'm never ever going to sell it. I'm going to leave the shares to my kids in the will. It doesn't matter, Julia.
So let's play that through. So let's say they never did sell it, and then it does go bequeathed through to the children or whomever. At some point, the asset is going to be sold. So is there a better concession that one might get because of the allocation of the units or shares inside the company for those kids? Like, does it reduce the risk of the premium capital gains tax being paid?
No, there's
no, it doesn't, does it?
No rollover. It doesn't go through your will. You're leaving the shares through your will, not the assets, so there's no reset. They've got the same problem.
Same cost base.
Yeah, because it's a company. Company's a separate legal entity from them. Yeah.
I think that's important to double click on that. It's a separate. Through its constitution, it makes its own decisions, and it's got people that make decisions on behalf. But they are distinctly separate from you. You may control it, but you don't own it. And I think that's important. And just for the people that are listening, the principal place of residence exemption is a tax concession you get on your own home if you were to trade that and you haven't done anything to change that exemption over time. When you sell it, the proceeds of the sale are not subject to tax. So it is a nice quarantine of wealth for the individual. So I guess to summarise that to Julia's point, if you make the decision to buy an asset within there, and for whatever reason it was your house that you were thinking of living in, well then that's gone. Or if you are doing it for an investment purpose, if you hold assets for longer than 12 months, you get a capital gains tax exemption, it's 50%. Well, that doesn't exist within a company.
No, that's right. And so the only thing, if you're borrowing money, then you do get the negative gearing, because obviously the borrowings, the interest is a cost, but that's a gain in the company, right? So it's not necessarily in the individual name.
Yeah, you could do something like borrow to buy the shares and play it that way. But of course, you guys would know just how more complicated you get it, the less lenders you've got and the higher the interest. Oh, banks only need to look sideways at you and they'll give you an extra 1% for this. And, guys, you've got to do this and got to do that, yeah.
So the way in which I summarise that is I've got establishment costs to set up the company. Mm-hmm. I've then got my annual ASIC fees that I've got to pay to maintain that company. I've got to do annual tax returns, which are full financials. So I've got to basically do my annual tax return plus the financials of the company as well. So there's additional fees and charges attached to that. There's not a lot of positives that I'm taking away from whether I'd use a company as the preferred vehicle for direct residential property. And we want to put context on that. Like, there might be some arguments for commercial or some other more exotic assets, but certainly for direct resi property, I'm not seeing any great value in that, Julie.
And there's always the risk you're going to end up living in your rental property and you're not going to get the main residence exemption on it.
That's the value. I mean, we saw the Labor government completely rule it out a couple of weeks ago in terms of when asked the question, are they ever going to tax the family home?
Took a little nudge though, a little nudge or two.
Jim Chalmers didn't quite nail it in the first couple of interviews. We're not ruling it in, we're not ruling it out. And then the Prime Minister, Albo, gets up there and says, it's a silly idea. Why not? Why not, Anthony? Why not? Because we're not going to.
It's political suicide.
It's exactly, politically it's suicide.
I think an important point too here is for a lot of investors, there's a lot of there's a lot of energy and effort that takes to buy that first property. So if you need to overcome your paradigm and your thinking and actually be able to think long term and swim against the tide and all those sorts of things, when you add complexity to the mix like a company, it's very rare for someone to do that at first, just for the logistics of trying to understand it. And then secondly, Julia touched on it, but it's important that you acknowledge that lending is a big part of the game. Right. Property investing is a game of finance just as much as it is a game of bricks and mortar. And if you put it into a structure, and we'll touch on that when we get to trust as well shortly.
Yeah.
If you've got options that are well and truly across the whole spectrum in your own name, you severely limit the amount of lending options that you have as soon as you add some structure to it. Whether it's a company, whether it's a trust, whether it's an SMSF, that's never easy to say, Ben.
That's why I always call it Smurfs now, because I just can't get that out quick enough.
So we prosecuted a case that company is not ideal. So
Can I just put a quick caveat on the end of that? a lot of people, we were talking about direct residential property. I'm sure Julia can vouch for this, but ultimately a lot of people whose businesses are just starting out and they're going really well and they're paying a lease for a commercial property, and then all of a sudden they get a chance to buy their own commercial property and they want to sort of buy that in the company and all that type of stuff. We're not going to answer whether that's a good or a bad idea, other than to say, okay, Julia, no, we are going to answer that. Go for it. Let's go.
All right. Well, I just want to say, if your business goes bad, you've got a dodgy tenant. So you've got the eggs in one basket issue here for starters. But yes, you do get a small business concession,
Yes.
Subject to certain rules, but which means that you get a 50% active asset discount, and there are other concessions that you may end up with it tax-free, but you still miss out on that 50% capital gains tax discount. So that's one discount you're missing out on, but it's not as brutal because...
That was my point. I was sort of saying, if you're doing a company, then and you're thinking about buying a property inside for your company, you've got to talk to your accountant. You absolutely need to talk to your accountant.
And it gets messier because that 50% discount's sitting inside the company. So you've got to actually go through the liquidation process to get it back out as capital.
Yeah.
So I'm just supporting what you're saying here,
Yes.
and that's, I think, why you wanted to dodge it.
Well, I
because
didn't want to dodge it because it's not what we do. It's not our wheelhouse. But a lot of people come to our business often and ask us, look, the business is going really well, and I've got an opportunity to buy the new premises that we're going to work out of now. And they also ask, well, should I put it in a self-managed super fund? But I'm opening up another can of worms.
Oh, yes.
And the short answer there is you're hearing, oh yes. But I just thought, because that just sort of really rounds it out in terms of, if you're thinking of just setting up a company as a passive vehicle to buy a residential property, doesn't sound like it's...
All right, so okay, we've prosecuted a case for companies, so it's probably, subject to you getting advice, it's probably not top of the list. So let's talk about same property, Julia. I've gone, all right, I now want to put it in a self-managed super fund. Can we talk to the pros and cons of doing it in that vehicle?
Well, the first thing that comes to mind with that is the borrowing. I mean, and you can't borrow against it again, so this whole leverage that people starting out with isn't there. So I say don't even think about it until you've got to the stage where if the bank lent you as much money as you could borrow, you wouldn't be able to sleep nights, so you don't mind capping your leverage. So, and your borrowing's far more expensive. Then you've got a bare trust deed, so you're running both the self-managed super fund and the bare trust. But if you've got the cash in your super to buy it, that's not a bad idea, but you've got to be very careful, definitely seek advice, because once you bought it, you can't borrow against it to repair it, or if you buy the land, you can't borrow against it to build a house on it. It's a very, very much a horse for courses, but the tax benefits are huge. You get to pension phase. Though we were just case studying a case where someone's got a property in a super fund and they're 80 and it's not producing enough rent to pay the pension that they're required to produce. So you've got to make sure you get some shares and some liquidity in there as well to be able to pay the pension. It's huge. It's something that you really have to go through, and you have to get your crystal ball out and say, well, this is what the future looks like. If you have one person die in it, then in 6 months the super fund has to pay out the money. If it's all tied up too much in property, you've got a problem. So, but it is the best tax outcome and the best asset protection, in my opinion.
So let's define a couple of things. So it's 15% in, 15% during, and then when you move into pension phase, there's the earnings are currently earnings are zero tax and zero capital gains. Have I got the summary right there?
That's right, and it's only 10% capital gain if it's in accumulation stage. But of course, these are assuming mum and dad situations, because we don't want to bring up the whole $3 million stuff.
Oh, no, I'm very happy to bring up the $3 million stuff, because that's got to be a consideration, especially with the unrealised, gains. That does make it a little bit more challenging, because where is that cash going to come from? You'll have to have some liquidated cash to potentially pay that. So it's still early days in terms of, we don't know what's happening with the legislation. We don't know whether it's going to get through. It's obviously not coming in until after the next election, but they're trying to legislate it in this current election period. Yep. But I want to come back to just talking about the structure itself. So yes, it's a beautiful tax structure vehicle. It's got real great incentives, and that's by design to encourage money to go into it. But we've always talked about the fact that the government was never going to leave it alone they're always going to, if they're going to look for where they raise taxes, it was going to be one spot where they've gone after it, and that's very clear. And I think most of Australians are pretty happy about the idea that there's a number on it. Like mine was 5 million, but if 3 million's it, and then you're going to be paying a little bit extra. But I want to go back to the point, because we've always talked about if you're not sophisticated as a money manager and have financial literacy and understand compliance and regulations and all of those types of things, it is a minefield. If you're thinking that you can actually run a self-managed super fund on your own and have it beautifully run and cleanly run, then, well, good luck to you if you're thinking that, because the costs are enormous. I've got 2 properties in my self-managed super fund. Obviously with the Bear Trust, I've got lending against both of those 2 properties. And I just know that in terms of, I see my tax fees, my audit fees, all the costs associated with running that as well. And I'm on record as saying what I did was I was looking at speculative locations where I believed that there was going to be a run on the value in those locations, because I didn't see myself holding these particular properties over the long term. And so if I could turn a $580,000 purchase into a $900,000 sale inside 5 years, I'm only paying 10% capital gains on that. So that was the strategy that I went into it. So if we're talking about the types of customers that would do that, I'm sophisticated, I know what I'm doing, I play in the space, as opposed to what we were talking about before, these spruikers who can potentially come into the marketplace and they're looking for, how much do you have in your super? If you have $150,000 or $200,000 in combined household super, and we can get you a loan and we can get you into an investment property, they're the types of mum and dads that I just, I cringe in terms of the operators who are trying to prey on those particular people to get them set up into those Smurfs.
Yeah, it's not so much the complexity of it, because that's why you have an accountant.
Yes.
But we can't stand beside you and collect the receipts all the time, and because they're audited, everything you do through the fund you have to produce a receipt for, and that's the real slowdown.
Yeah.
That's
I think that's a good point too that both of you have made, that it's most people who have contributions to super are doing it on a passive basis. Their employer's doing it for them, they're sending it to an organised super fund who's specialising in fees, ongoing structures, all of the rules around it, whereas when you're doing it yourself, the complexity comes back to you. If you make a simple mistake, the auditors aren't as friendly, and then there's all sorts of regulations that you've got to notify the mistakes that you've made. And I think to the earlier point that Julia said before is you've got to make sure that there's a level of liquidity there that allows you to get to a point where you can actually pull out enough of the fund, because by nature property is generally illiquid, and getting access to those funds. So typically speaking, it's better to get smaller valued properties within the fund so that you do have those liquidity events down the track if you want. Secondly, because you've got a 15% tax environment, the negative gearing is, if you're at 37 cents or 45 cents now, the negative gearing is higher. But when you're at a 15, I've got a little point there, so I'm worried about what Julia's about to say, but the 15, at the 15%, the negative gearing is lower.
Yeah.
So you generally need, outside of super, we love to buy the old gems, the 100-year-old properties that have got lots of capital growth, but they're lots of maintenance rich as well. But that maintenance gets us the ability to negative gear in our own name. So
yeah. And you need the yield to get the servicing.
Yeah.
So that's the other part why you'd always chase those sort of regional areas where you're getting that higher yield as part of being able to even just get it off the ground. So I think you make a really valid point.
But I am nervous. Julia put her hand up, so there might have been something that I said.
Right, and this is not about the whole picture, but just about the tax bracket. And this is fine if you're putting the maximum $27,500 and all your unsaved caps in every year. But if not, you achieve exactly the same result. If you're looking at a property that's going to make a $10,000 loss, you put it in the super fund. The super fund sure makes a $10,000 loss, but you put $10,000 in as a super contribution to cancel that out. You would have had to do the same if the property was in your name. But what you've done is brought down your taxable income by $10,000 anyway, and it's cancelled out here. So you've effectively got that $10,000 deduction at your marginal tax rate.
So it's usually the servicing that's the challenge, because to your point, and then trying to buy that pure capital growth asset in a city location, very hard to do. My final comments on self-managed super funds is what I've observed and I'm not saying this for our community who are listening along or watching this particular piece, is that most of the time where we see sophistication and knowledge built is one property, then two properties in personal names, and then the third property is that optional, whether I do it in my personal name, or do they look at getting into a self-managed super fund, because they've taken a journey of knowledge building and they're starting to get more and understanding how tenants operate, how their property manager operates, and they're understanding how lending operates. And so they've built up that knowledge to sort of get a bit more confidence and then ready to take that next step. And if they've got the comfort of working with a specialist tax advisory firm or self-managed super fund specialist from a financial planning point of view, I do see that happening in firms who are very good at that sort of space. So they're taking people on that journey, and then the customer can either tap out for the $2,000 that they've already got, or if they want to keep moving it forward, that's an option for them. And I think that's probably the best example I can use, as opposed to low financial literacy, not good for mum and dads, only good for sophisticated people.
And my only thought is that if it's only going to be one property in there, it's a lot of overheads.
Yeah.
So, and I know what you're saying about as they get along and they get more experience, but now that you're capping it and saying, well, they only need 2 to 3 properties, well, by the time they get through there, they're running a super fund for the last property. So...
Well, it's a good example of case by case, isn't it? Once you then get line of sight, because you might have really high income households and it's just like, wow, they've built up a significant portfolio of super funds. They don't need to take a significant bare trust, or they might even be able to buy it outright in cash, or there's those types of other options, or even with the holiday homes, and I know you're not allowed to buy it for that purpose, but when you're in pension phase, I am hearing stories of people in pension phase turning those properties into accessible lifestyle assets for themselves after they've retired in pension phase.
But they've got to take it out of the super fund.
Yes.
So here's a really, here's a really nasty twist. So when you're in pension phase, you can't take an in-species contribution out. So you have to put it back into accumulation stage. And then if you take it out, it's notionally a capital gain, so you're going to cop your 10% tax again.
Well, I think they're not too worried about 10% if it's a nice family home or holiday home that they've...
Yeah, but they've got to get it out of the super fund.
Yeah, good point.
Take some plan.
So, and just to round out that discussion too, Julia did touch on this, but I think it's worth sort of reinforcing. If you have equity in the property and you feel like you can add value to it through a renovation, well, you better hope you've got a cash reserve to do the renovation, because you can't borrow within it, and you can't borrow within it to get the equity, right? So that's a limiting factor for people who are on the accumulation journey, because they're usually trying to leverage previous assets that have grown in value so that they can keep going along the journey.
And you make a really good point there, because I've had a look at my interest rates on my current self-managed super fund loans recently, and I'm like, oh man. Like I got one, I think from memory, is like in the 9s, almost 10% in terms of, so that's the other big problem. And you mentioned that earlier with the company stuff, is because there's only a limited number of businesses that now operate in that space. And if the current government get their way about the $3 million cap, I don't think self-managed super funds will be the vehicle that most people use for direct property in the future anyway. So there could be even limited options. I should be, and I will be, refinancing and looking for a cheaper deal, but I don't have many choices in terms of who I can refinance it to. So I'm now caught with a real high cost, even though the properties are yielding beautifully and they've grown in capital value quite substantially since I bought them. That's a problem for me, right? In terms of, which comes back to, it might have gone all right, but I'm giving all of my money off to all of the people who are running it.
So why don't you let me, just thinking here, become a member of your super fund, right? And I bring across enough money to pay out the bank loan, so you still get to hold your properties. You see, that's the beauty with self-managed super fund, because it's audited. We can never fight over anything.
Yes.
Because the auditor's got the final say, and there's all these rules, even to the market rent and all that sort of stuff. And then you've got rid of your loan, and you can have up to 6 people that you bring in that way.
I was just about to say that's good. No, I mean that yes, it was originally 4, now it's gone to 6. So another example of, we've been generally talking about the pros and cons here. There are always exceptions to the rule in terms of where that might be a solution. to be able to sort of look at that.
Well, we heard it here first. Julia's now coming into your super fund, so it was very gracious. I'll let you know if you can come into mine, Julia. Okay, so we've covered off companies, we've covered off self-managed super funds. Okay, now I'm going to go on same property, same scenario. Julia, I want advice on you whether I should put it into a trust. First of all, we've got 3 trusts to talk about. So before we talk about that, if I came to you and said I wanted to buy that same property within a trust, which one off the cuff, generally speaking, at a headline level, would you probably direct the conversation to?
The only one I'd be interested in would be a discretionary trust. Do you want me to explain?
Yeah, please.
Yeah, right. So I'd throw out the hybrid because they don't work. Simple as, because they're trying to be both, and as a result they end up being only a discretionary trust. You're still going to... Okay. With the unit trust, I'd have to say, well, why are we doing this, Bryce? What are you doing it for? You're in a trust, so it's going to be more difficult to borrow. You've got all the extra operating costs, and you've still got no asset protection and no flexibility of distribution. So,
and your losses are trapped inside?
Well, no.
No,
because you can borrow for the units.
Good
but
point.
What I'm saying is that unit trust is the same as having it in your own name. At least you've got the flexibility if you ever live there,
yes,
or you're about to die and you go and live there and get your main residence exemption on it when you die and resets it all.
So my first question to you then, I'm sitting opposite you or in a consultation, I'm going, okay, why is my asset protection no longer there? I'm within another entity. That seems counterproductive. Can you explain that?
Because you own the unit in the unit trust, and that unit you might own one of 2 units. Say you own 50% of the assets behind that. Your creditors come along, they get that unit, they can go in and access those assets through that. And the more clever you get about ways of stopping that creditor getting it, the less chance you've got of being able to deduct the interest on the money you borrowed to buy that unit, which is how you get your negative gearing out within a trust situation.
Yep. Okay, got it.
All right. So unit trust is a no. Hybrid trust is a no. So we go for the discretionary trust.
Right.
So for those people who are not familiar with the structure, it's essentially, as the name sounds, you have the discretion to determine which of the beneficiaries get the income, the capital units, right?
Yeah. So for that reason, well, there's no units. In other words, they get the income. The capital gains, So for that very reason, if you borrow money to put it into the trust, there's no nexus, there's no fixed right to return. So you don't get a tax deduction for that money because it's not a cost of earning income. So the borrowing happens in the trust. So the trust borrows the money to buy the house. And if initially that makes a loss, well, that's it. You can't distribute a loss out of the trust, so it's locked in there. There are times that may work. If it's a positive property, well, then you've got to look at who you've got that you would be distributing to and say, do I just put it in the name of the low income person that I'll always distribute to for the rest of the time I'm going to own the property? And usually low income people have got very little risk. So you might just do that and save yourself it. Or you might say, well, I've got kids coming up going to university, and once they turn 18, providing the money I say is theirs, I really do give to them, and they pay their HECS debt or whatever, and then they pay the tax on it at normal tax rates. So that's a really good plan to do that. And you might even, assuming by then it gets positive. So you might even say, well, initially it's going to be negative, and then as I pay off the debt and rents go up, it's going to be positive, and then the next thing you know, my kids are 18, so when it became positive, I get to use up those losses. I'm still not paying any tax yet. And then the kids are 18 and they get it for years while they go through uni. That might be the vehicle for you.
Well, I'm going to give you 2 scenarios. So I come to you in that same scenario you just described, and I'm a pay-as-you-go income earner, one. And the second one is I have a business, and my business income has the ability to distribute to that trust. So those 2 scenarios have 2 very different outcomes, don't they?
Yes. So if you've got that loss that I was talking about in the initial years, if you've got a business that's also in a discretionary trust, you can make certain elections, and that business can distribute the profit to the trust to soak up the loss. Or basically, the way most people look at it is they get to use those losses over here against their business income. So, and that's, whatever your business ends up with, you're going to be paying tax on. So it's as effective as a tax deduction for you. So yes, if you have a business in a trust that can distribute to your one, that's a no-brainer to buy it in a discretionary trust if you're never going to live there. But you can't do that with personal services income. It's got to be proper business income.
And the capital gains, 50% capital gains exemption?
You still get that through
Still
trusts.
get that as that.
Yeah.
So I have seen some example case studies where exactly the one you were talking about before, with a couple of sort of teenage kids where the households have got good income coming through, and the recommendation was to buy it in a discretionary trust and then effectively anticipate that those costs and distributions would go out to pay down the education fees for their children, and then basically that gives them a starting point and, as you say, potentially a place to rent as part of that particular story when they might be going through university or whatever that looks like. I still think that that's a niche use of it, as opposed to a straightforward use, whereas most of the other times it's usually when I see business owners who have income coming from a business pursuit and a business activity, and then they have the discretionary vehicle and trust to obviously allow that money to flow through to the beneficiaries as part of that. And that's quite common in terms of if you're looking to set up a business that is going to have, you know, aspirations of it earning quite good profits over the journey, that way that structure would play its role.
That's absolutely ideal. And just a little disclaimer there that don't put the property in the same trust as your business.
Yes.
That's all separate trusts.
Because then your asset protection gets distorted again. And I guess the final scenario is, okay, Julia, same property. Now I want your advice. Now I just got to let you know I went to this seminar on the weekend. Just hear me out, right? and at the seminar they said to me that I could get the best of both worlds. That they've got this thing called a hybrid trust, and I can actually get the benefits of the negative gearing through getting the units, and then at some point in the future, that's got to sound amazing, surely.
Yeah, well, there's lots of rulings out, and it's all been done to death, and it just raises its head every 10 years or so, and you know, because everyone's forgotten about the mess that it created. Because can you imagine if you're in the wrong setup and you don't get a deduction for the borrowings for those units? You've got to pay stamp duty and capital gains tax or whatever to get the property out of it. The nightmare of it not being right is a go. But anyway, the problem is, as I said, you've got unit and discretionary trust powers. So if as you believe them and say it's in a unit trust position now, you haven't got the asset protection, they'll tell you anyway. So you're getting and you've got to borrow outside and the only way you're going to get a deduction for the interest on that borrowing is if you're entitled to the income and capital growth of the property, because it's assuming it's going to be negative geared. There's got to be a real prospect of making a profit. In fact, it's Fletcher's case, where there was no prospect that he'd ever get a profit out of it. It'd end up going to his kids, so there was no deduction for that interest. Because what happens is the minute it gets profitable, they flick the switch through various mechanisms to discretionary trust, and you didn't get the profit. I mean, that's the whole goal. They're saying you get the best of both worlds. Well, it's exactly that same reason that you don't get the deduction on the interest for the borrowings to buy the units, because you've got no chance of eventually making a profit. So exactly the same reason they sell you that deed on is the reason that it won't get through.
They waved this ruling in front of me at the seminar, Julia. They said, we've got this tax ruling here, so we're fine, surely.
Yeah, and if you read the ruling and what the deed says, they don't match.
This happened obviously in early the 2000s,
Yes.
when I was sort of starting up my business, and I was talking to my tax advisor at the time to sort of say, have you seen this new structure? Gives you the best of both worlds. You get to claim this, put your income in one side and give that out to the lower income, and then the capital gains and he said, yeah, right, sure. He's obviously, it wasn't his first rodeo, and he says it's unlikely that it will get a private ruling or this particular situation. And yeah, I mean, it was flavour of the month for a good 3 or 4 years, and then it died away. And since then, obviously being in the mortgage broking side at that time, there were several lenders who were dabbling with it. These days, the lenders who will even go anywhere near it is as rare as hen's teeth. Everyone's learnt. The ATO have made it really clear that you can't have your cake and eat it too. And so they're very expensive to not only set up and run, but also the interest cost on those are also exorbitant as well. So for me, it's a 100% don't touch it with a barge pole scenario.
And to give you an idea of the sort of advice you get, I was given a hybrid trust deed to read by a client, and I said, that matches this ruling I've read over here. And they didn't get, and so I rang the solicitor, its name's on the deed, and I said, I think your deed's that, and it doesn't work. And he said, yeah, that ruling is our ruling, and yes, it was knocked back. I said, but you've just sold this deed. He said, yeah, we sell it with the disclaimer that get advice from your accountant for the tax consideration.
Oh my God.
So even when you think,
wow.
I can offer anecdotal evidence, Ben. You said back in the 2000s. I was involved in a group. I'll just keep names out, but they were involved with hybrids, so I saw it all the time. So I was playing tongue in cheek, but yes. I saw lots of people come to me with the same thing. I got this ruling. It's what we want to do. And I remember at the time I was guiding the people against that. I wasn't in a position where I could give them the advice. I pushed back to the accountant, but I said, because I wasn't in a position where I could give tax advice, the way that I sort of helped the client understand whether they should proceed was I just talked about lending.
Yes.
I said, I knew it wasn't a great idea from a tax position, but I couldn't talk there. So I said, and for people listening to this, they can't see it, but my arms are wide stretched here with the options that are available. And then I just showed the person, but you've only got these small, narrow options, and it usually was the umpire that tipped them over the edge. So then most of the time they never did it. So then what happened is I get a call. I get a call from upper management, Ben, that says, hang on a second, we've been checking the numbers, and the Perth team, they're doing lots of hybrids, and the New South Wales team are doing lots of hybrids, and the Victorian team are doing lots of hybrids. But there you are up in Queensland, Bryce, it's close to zero. Why is this? And so that was a good reason. That was a challenging conversation to have. That I didn't believe in it, my heart wasn't in it, and these are the reasons. And look, if humans are the study, if economics is the study of human incentives, I had an incentive to get the client to be able to be in a position to get to the starter's line so that they could buy a property. So I was actually doing the human incentive line of saying, well, if you actually want to stay stuck in theory land and never get anywhere, go knock yourself out, go and get this trust and get it all sorted. And then when you get to the broker and they tell you haven't got any options, well, then you're going to come back to the starter's gate anyway, but you'll have gone through all these expenses, or we can just move through the gates quickly. So,
but a good lesson for everyone, good lesson for beginners. If it sounds too good to be true, it often is. If people are claiming certain high gains or effective tax strategies and structures, I mean, we haven't even talked about interest on interest calculations, but we do know that there's a narrow window in that. But and the advice I got back from my accountant, he says, if it becomes too popular, they'll shut it down.
100%.
Right, and it's a similar sort of way when discretionary trusts, which are also great in terms of allocating income to your children. You could allocate up to $2,000 or $3,000, whatever it was at the time. If everyone starts to do it, they'll find a way to shut it down, and they found a way of shutting it down. So it's obviously not worth it for the minutes and the cost to get that done to give a couple of $100 to your kids these days.
If you're going to get away with it, it's got to be in the niche. As soon as it becomes mainstream, you are.
Yeah, and what are we telling everyone in our community? It's like, they're going to keep coming after super. They're going to keep. So if you keep making money, they'll keep coming after you in some way, shape, or form. And that's why we've got the quality of standard of living we've got in this country and the safety nets that we've got, because it requires tax revenue. And those people who beat it, they eventually, if too many people start beating it, they want to try and change the rules.
Well, I think they're now trying to do that with work-related expenses from working from home, aren't they?
Yes.
They're going, oh, there's too many people working from home and claiming this 80 cents an hour. No, we've got to change that.
Exactly.
Now they're basically making it impossible.
It's a classic.
Well, the government's a business. They've got to fund it.
Correct.
They've got to fund it. So it's not just a benevolent organisation.
They just don't use it well enough. That's our problem, isn't it, Julia?
Yeah, well, it'd be all right that's a separate story.
If they spend it well, we'd happily give it to them.
Yeah.
Well, they've got business-like process then. Maybe they don't run
exactly. They're not very good at running it.
All right, so we've gone through company, we've gone through SMSF, we've gone through 3 different versions that you can do for a trust. So let's talk about personal name. It's the 3 of us who've been doing this for a long time collectively. There's scores and scores of years, and we've all said that the majority of what we've seen is people doing in their own names. So there's a couple of things we need to talk about here. Ownership type, Julia, and then we want to talk about ownership ratio. So Do you want to kick it off with the difference between joint tenants and tenants in common?
Okay, so a joint tenant inherits the other tenant's right as soon as when they die. It's the wrong word, inherit,
It's the
actually.
rule
It's
of
automatic.
survivorship.
Yeah, they automatically get it, doesn't go through the will, nothing like that. Whereas tenants and joint tenants own it equally. So if there's 3, they own a third. If there's 2, they own 50%. Whereas tenants in common, it goes to the will, whatever their share is, and you can change the percentage on it but if you change it at any time in the percentage, like if you owned it 50-50 and then you go 70-30, well, that's actually selling part of the property. It's a capital gains tax event and stamp duty event. If you own it as joint tenants and you go, oh, I don't like this person anymore, I don't want them to get it when I die, you can go and change it to 50-50 tenants in common, and then there's no capital gains tax event because you still both own it equally, and there's no stamp duty on that.
So joint tenants is basically the rule of survivorship applies.
Yep.
Whereas tenants in common is like a business structure. You have to go through the will. So here's one for everyone to ponder. Let me know if I've got this wrong, Julia. But my wife Andrea and I could own a property with you and Jane and Julia, right?
Yep.
So let's throw this. So and we'll own a third each. So I'm tenants in common with my wife as joint tenants for our third. You're tenants in common with your wife for a third, and Julia is tenants in common for her third. So the rule of survivorship would apply within our share, but it's still only the 33%, whilst the 66% stays with you, and the same applies with you, Ben. So did I get the technicality of that right? We can do a combination of both, is probably my point.
Well, when you told me that the other day, I thought, well, I suppose you can, and it's interesting to know, and I hadn't thought of it. So no, I'd say yes, I heard Bryce say that one day, and it sounded good. I think you're right,
It's very rare that Julia takes advice from me, Ben. Very rare, but
well, it comes back to that joint tenants point as well. I think
Makes sense.
with relationship breakdowns, that's usually the common reason why that doesn't trigger that sale event and so forth. I know that there's obviously a lot of examples where relationship breakdowns have pathways that allow for not being hit by extra capital gains or stamp duties or any of those types of things as well.
There's all sorts of rollovers.
Yes.
But what you want to do the minute it starts to break down is race in and change it to tenants in common, and then you go through the process of a binding financial arrangement.
Great bit of advice there as well.
So that's so get your head around that, folks, as you sort of think about structures in your own name. There is some combinations that you need to think about, whether it needs to be a business structure or the rule of survivorship applies. Secondly, when I was first involved in the game back in the late 90s, early 2000s, there was a big encouragement to go 99 and 1. 99% in the name of the higher income earner, 1% in the lower income earner. The rationale at the time was because if you're using a jointly owned asset as security to buy a purchase, the bank wanted to see at least some form of ownership, 1, and 2, you obviously wanted to stack the tax benefits in the higher income earner's name. And then the thought was you slowly wind that back over time. So 99-1, the second one, you move if you could closer to 50-50, then on the third one you flip it. So it's all about maximising the tax advantages early, but then getting the balance over time so capital gains in future events would be balanced.
And based on the negative gearing or the property running at a loss at the start was why you'd go in the higher.
Yeah.
Yeah.
But not as prevalent now. There's more of a preference for 90-10.
Well, that's another thing I learnt, so I do listen to you, is you're saying the banks don't like the 1% anymore, they want the 10%. So
that's what we see in terms of, we understand like ultimately if you're running that way and it's for tax purposes, you run the risk of the tax office asking you why you've got a structure in that way. So whether it's the dominant purpose is because the contributions of money are coming in based on that household structure would probably be one maybe argument you might raise. But if it's purely based on the tax outcome, you've got a problem. So, and I think what the banks have also sort of said, and sorry, there's a bit of a backstory to this, but prior to the responsible lending rules that came in, you could do a security guarantee or you could also do a servicing guarantee. And so that meant that if you had yourself as a young 18, 19-year-old and you wanted to buy a property, and you didn't have the income to get the servicing of the loan, you could go to your parents and basically, mum or dad could come on, or both could come on and say, we're adding our income, and the banks were like, that's great, as long as we get paid our money back, we're happy to lend it out. And so that was a servicing guarantee. Responsible lending came in, and the whole idea of responsible lending is you've got to pay the loan, no one else can back you up on that. And so ultimately that meant that the servicing guarantees were dead in the water, the security guarantees would remain in place. And we saw a theme of the lenders then sort of starting to say, all right, well, if you're going 91-1, is that purely just to try and get that higher income earners, on the book so they could help with the servicing? Banks just thought we could smell something here, and so they want a little bit more exposure or interest in the property.
Skin in the game.
A little bit more skin in the game for that person who looks on paper is going to be paying the bulk of the repayments coming in. So that's the story. Very hard to get that documented clearly, but usually it comes back from the credit sort of saying, what can you get a letter from the accountant as to why you're doing a 99-1? And then accountants might go, whoa, actually, I probably don't want to, especially if the higher income earner is the 1% owner. It's like, well, maybe you can't argue that they're going to be contributing. So it's like, all right, wait a minute. So you then get a little bit of a pushback, and that's sort of how we're seeing it playing out these days. And I think it's with probably the next question for you, Julia, is around with the proposed stage 3 tax cuts. What does that really mean?
Legislated.
Well, they are legislated.
There's a fair bit of political heat on them right now.
They're gonna. Let's see what they do.
So from the 1st of July 2024, which is only a bit over a year away, the tax bracket for anyone that earns between $45,000 and $200,000 is coming down to 30 cents plus Medicare levy. So in your scenario where you're thinking negative gear in the high income earners, there's got to be a huge disparity between the two people to actually be, because it doesn't matter if you're just get over the 45,000 or just get under the 200,000. As long as you're in the same tax bracket, even though there's a big difference in your incomes, you've done everything you can to minimise the tax. But the advantage is when you come along to sell the property, you can't just sell off a couple of rooms this year and a couple of rooms next year. You've got a huge capital gain in 1 year. So you've got both your super caps to try and put some money into super to minimise that down, and you're splitting the gain 50-50 across. So you've retired, hopefully, and you've got no other income. So it should at least halve the capital gains tax bill because you held it 50-50 instead of 99.
You raised something there that triggered some interest around distribution into super. If it's an investment property, are you able to distribute into super of the sale of that asset?
Yeah, but it's just like any other super contribution. So you've made $100,000 capital gain, you get your 50% discount, you're about to be taxed on $50,000, but you put $20,000 into a super fund and you claim that as a tax deduction. Okay. So you end up only getting taxed on $30,000.
Right. So it's not the new rule around encouragement of selling the principal place of residence down, of which you can get an additional amount that you can add into super.
Yeah, that's the downsizer, and that's not tax deductible.
Yeah, got it. No, that's helpful. So it's only that 27.5% cap that you can play around with in terms of being able to reduce that capital gains result from a sale of an investment property.
Yeah, and you get to reduce it after the discount, unlike capital losses, so it has potential there. But it gets taxed 15% going to the fund, so I think your viewers will right, but she's only saving 4% there, but in the higher brackets it's significant.
4%'s 4%.
Yeah, it's better in your pocket than theirs. So do you think that stage 3 cuts will go through as legislated without any go on record? Oh,
look, probably not. There's a lot of political pressure. There's a lot of stress in the budget. Depends how well this new super legislation is received. They make no mistake. Jim Chalmers wants to change it. Does not want to do the stage 3 tax cuts. I think you'll find that inflation is going to play a big role in that as well.
It's incredibly inflationary.
If inflation is hanging around, that they might pin their argument to the higher inflation. This is only going to make it worse, which means unemployment's going to go up. But I mean, in terms of the reaction from most people is when you start taking money away from them, you normally get a little bit of resistance. So it certainly bodes well for the Greens party in terms of their constant whinging and attacks in that particular space. But I certainly think that the left side of Labor certainly want to make sure that nullifies the Greens' argument when they're going into the next election.
Well, on top of that, they're taking away the low income tax offset, so they're moving it, that movement. Whereas I think inflation is just going to mean wages are going to go up, and suddenly it won't seem that painful. Could there be, most people will be over 200,000 a year. So
but that low income tax offset is
maybe they'll change that to make it up a little bit better.
Maybe that'll be the sweetener.
Yeah.
They've certainly got a lot more revenue coming in, with their exports are at sort of 90, 100-year record highs. So I think the budget's going to look a little bit healthier. And if Governor Lowe and the RBA can pull off a miracle and land the plane, through the eye of a needle, then that will mean employment will be sub 5, maybe 4.5, and that means that just the general tax revenue will be higher than what's currently forecast by Treasury. So if they've got a little bit more money in there, it's interesting. They're still doing nothing about stopping spending.
Inflation is the biggest picture in that, because they don't want to be seen as backpedaling on election promises. I just think it's inflation that's going to have the big say in that. So if we summarise personal name, simplicity,
100%,
efficiency of cost, optimal lending options, optimal
pricing on lending.
Yeah. So we come back to the where we started here with this whole conversation around the myth around asset protection. But it is the least asset protection of all of them. So it becomes a scale of which one matters most. But one thing that you spoke to me about last week when we were chatting, Julia, was a concept of the mortgage trust that can assist with asset protection in your own name. Now that was a new concept for me. So perhaps you can share that with
don't try this at home on your own. So the idea is that you've got a $500,000 property and you borrowed $400,000 from the bank. So if you do something wrong, your creditors are coming along, they're going, is it worth hassling for that extra $100,000? Maybe they will. But as it goes up in value and as you pay the debt down, it's $400,000 equity. They're going to go, yes, we're going to go that. So what some solicitors will do for you is they set up a trust. Now, this is not a tax thing, so you don't have to worry about all those things, the tax law. So they set up a trust and they have bank managers that will do it. And I think, well, this isn't what really happens. Just picture you're in the bank manager's office, there's a pile of $400,000 sitting there on the desk, and you say to the bank manager, lend me that $400,000, so pushes it across to you, and you go and deposit it in the trust bank account. And it's a gift. You've given it to the trust, you still owe the bank manager, but you haven't left the building yet, so you're fine. And then you go to the...
That's important detail, Ben.
Just
you haven't left the building yet.
Because the bank manager's going to lose their job when they've just put $400,000 across the table with no security.
So then you go to the trust and you say, I want to borrow $400,000 from you. And the trust says, well, what are you going to give me as security? And you say, well, this property over here, I've got $400,000 equity left in it. So the trust takes the equity. The loan's no interest or anything like that, but you've now got the $400,000 and just give it back to the bank manager and he's happy. But meantime, you've secured the second mortgage over it. So the next time the creditor comes along, you've got your bank's got still $100,000 and your trust has got the other $400,000. Now you've got to be careful because, as you know, they can claw back if you do this sort of thing to avoid your creditors if you're already in trouble. And there's sort of that clawback period of a couple of years. So you wouldn't want to do this every year because odds are every time you do it, you're exposing the whole arrangement to a clawback. But every now and again, if you suddenly have you might go back and to the bank manager's office and do it a bit more.
It's a very niche idea in terms of that, and obviously there's going to have to be a lot of coordination in terms of which banks might have an appetite for doing it, and obviously which solicitor groups and all that might have an appetite to it. So I think from where I sit with it, I'd like to learn more about it because it's a new idea. So maybe, as we learn more about it, we might share it on further updates if it's going to be possible. And it's something that, and again, it's, this is a risk mitigation strategy. That's all it is. It's not a there's no better benefit for tax. There's no other sort of benefit from it other than, again, protecting yourself. But to your point, most people don't work out that they've got a problem, and by the time they've got a problem, it's too late because they'll claw it back, because you got that 1 to 2 years. So it's a cost. It's basically a defence strategy that you're making over time if you maybe are in a high risk environment, or and you've bought everything in your personal names and you're a doctor or someone who has a high risk.
Even on your home.
Yeah, even on your home potentially could be a play. So again, I think it's a specialist advice on that in that particular space.
There you go. So that is a potential way to offset the asset protection. So there you go, folks. Personal name. There's some tax rate concessions coming, but I guess the whole idea today was for us to equip our listeners with an opportunity to assess what entity they should be buying it in. We've covered off some of the pros and cons of each of the structures, but I guess by conclusion, it's really case by case, simpler and easier in your own name, and it just becomes a scale of complexity versus risk. Where do you see yourself on the risk scale of the anecdote that was for me, Ben, back in the early 2000s was, what if you're driving your car and you happen to hit the farmer's prize bull and turned his prize cow into sausage meat? You'd get so. That was almost word for word.
Well, that's what they use. They use that fear. Where do I sign?
Mate, I've done a few drives down a country road, Ben, and I've seen a few prize bulls, but I haven't hit one yet. So not to say that it'll never happen, but it's just, where do you see versus someone who's in a highly litigious environment, by nature, by what they do, it would absolutely make sense for them to actually get serious advice around whether they need to put their assets in. And by the nature of the litigious and complexity, they might have an appetite for the complexity of managing their household affairs. But generally speaking, most people are not in the firing line. They're not in the crosshairs of anything. Therefore, they would just need to weigh up their risk versus what it takes to put it into a structure.
And we've done this, over 3,000 times for clients and so forth as part of that. And the bulk of those clients have gone in their own individual names. And the other part to that is we're able to model that story for them in terms of, splits in regards to impact of my income, higher income, lower income. And because it has been legislated, the 2024 tax cuts, we've actually modelled those into our simulations. So we just show the customer, here's the tax outcomes as part of, what sort of structure. And it's pretty clear that, over a 20, 30, 40 year period, there's $80,000, $100,000, $200,000 variations in some cases. And so people go, all right, well, sounds like personal names as a go, cheaper money, simplicity, those types of things. And they normally execute on that. But when we do get those interesting cases where the wife's a doctor and the husband's a lawyer or an accountant, and they're in professional areas where there's high risk, it's like, all right, well, this is interesting. So let's take that offline, talk through the pros and cons of that, and then settle on a decision, eyes wide open on that decision. But once you're in, and once you've made the execution in that particular entity's name, that's it. You want to move it around, there's stamp duty, there's selling costs, there's all those other aspects attached to it, isn't there, Julia?
Yes, that's the trouble with the property. And then you've got to go back to the bank too. Yeah,
yes, everything's a mess.
You've got to get it right the first time.
Correct.
Julia, thanks for joining us on The Couch today. It's been fun. You obviously study property tax better than anyone else we know. We love riffing it with you, and just let me know next time I hear in my emails or get pinged a text message of a seminar where they're going to talk about property. Should I give you a call to come along or not bother?
And I can heckle from the peanut gallery. Yeah, right. I'll be escorted out real quick.
Always good to catch up. Thanks for your contribution too, Ben. And folks, hopefully that's added some value to you if you're faced with that decision or have been faced with that decision in the past on which entity to invest in. Well, there you go, Ben. Couple of professionals, well, two professionals and me, just talking around the fire, just having a little conversation about tax structures. I thought that was fun.
Very measured, wasn't it? The whole episode has been a little bit low energy measurement in terms of we're just getting into the facts around what we're doing. Everyone's used to the whole sort of rah type stuff. No, measured conversation, measured everything. So no, hopefully that's what we want to hear, the feedback in terms of whether people like the content, very measured. Did anyone fall asleep during the show?
Well, no, I think hopefully people get a bit of an understanding on a couple of things. We can't give you tax advice, but we can give you information to digest. And anecdotally, there was a clear winner across the three of us around the observations that we've seen over 20 plus years of people primarily buying it in their own name if they don't fit into the outlier category. They're in a litigious environment, all those sorts of things. So we have covered this topic before, Ben, previously. So we've done it in Q&A day at certain parts, but it's just the depth that we went into, and then the opportunity to have someone who has spent a career specialising in property tax, Ben. We couldn't let that opportunity go.
Yeah, a bit of a refresher for everyone, for those, who may not have remembered why they did what they did, but also for our new audience coming to us as well, what's available to you in terms of those strategies. So, I'll double click on what Bryce is saying. It's really clear that the reason why most people buy in their own names is because it's the most simplistic, easy to operate, and you don't necessarily have all the additional costs and compliance and regulation around that. So there are still, obviously horses for courses, and in several cases it can be worth looking at those structures and those vehicles. And that's a really good point. Hey, and Bryce, I just wanted to mention, we did talk about that mortgage trust or mortgage idea in terms of asset protection at the end there. So now from post that chat, we just want to also highlight that it's really important that idea would work for a very niche group of people.
Yes.
In fact, we did some reading on it later on, and we found out that there's also been cases where it hasn't stood up under the test of law. But that's based on the feedback we got from one of the lawyers that we were talking to about that. That basically said that was because they didn't set it up correctly. And so it really is such a niche product that as much as we sort of put it out there to say this is what's available, it just reminds people that there are some very sophisticated opportunities and applications and structures. But we want to remind everyone that before you do anything like this, you also want to be talking to an absolute specialist in this area. And I'm not just talking about a general counsel. I'm talking about a tax lawyer, so an absolute tax lawyer who specialises in this particular area to see the pros and the cons, because what it also needs is coordination through a lender, and that will also restrict you in terms of working with that lender going forward. And so what does that mean about interest rates and flexibility around that? What will they charge you? So all of those things are really important. So as much as it's available, that's for a slither of the population, and it's not something that we would be recommending for the mainstream audience out there.
You hear well said. For the majority of the people, it doesn't apply to you. So very, very good. Hey, and again, thank you to Julia for her time. She was a little nervous at the beginning, Ben, but there was no signs of nerves throughout the conversation. So we appreciate her doing that as well. Hey, my life hack today, Ben, is something that we've been getting anecdotal feedback from our community.
Yeah.
And using the More app, MOOR, right? So, and it's really nice for us to see where the feedback is coming from our community as to where they are getting the benefits. But one of the main things is you can actually now have a look at your wealth speed, but you can also look at your income speed, and that income is broken down into working income speed and passive income speed. And you and I were chatting about it before we hit record today, that some people are seeing that as an epiphany moment where they're going, oh, okay, the working income speed compared to my passive income speed is well out of where it needs to be. So all of a sudden it's putting attention and light and energy and focus on the fact that the whole game, because if you think about the $2,000 per week that we talk about here for the last 434 episodes, that's a passive income where your assets provide you with the income. So if the end game for you to get the lifestyle design that you need is to get that passive income speed up, what we're finding is people are going, right, that doesn't feel right. So they need to be putting more energy and then therefore asking the right questions on actually, how do I actually get that speed up?
Yeah, we've talked a lot about how Wealth Speed talks about future pacing, but bringing that opportunity or that issue from the future into the present time. There is no better way to illustrate that really in terms of comparing passive income speed versus working income speed. So if you're miles behind on your passive income speed and you've got a really healthy working income speed, what does that tell you about how hard your money's working for you? So that is, this is that problem aware moment for some who, the whole idea of the concept is to try and allow you to take action. And that really just brings that sort of future challenge that you've got into the present moment and allows you to really see that crystal clear. And we're seeing people going, thank you. Now what do I do about it? How do I make my wealth speed go quicker through the investments or reallocating of my surplus income into some of those investments, which will increase your passive income speed?
Very good. So if you haven't checked it out, folks, I cannot encourage you enough to go to the whatever store is available on the whatever device you're using and download that app, MOOR. If you're part of our community who have an old MyWealth portal, log in, and you haven't yet sort of checked it out, it's super easy. Go in, log in with your credentials, and all of a sudden your data will come up straight away. But it'd be fair to say the MOOR app, Ben, is trying to solve that problem that you just hinted at then, is how do we make a future problem something that people discuss and talk about right here in the present? Because quite often we have conversations where people go, oh, I really needed to be doing something a little bit earlier, which is true in some cases, never too late to start, but in some cases you can miss the compounding impacts of time. So really it's not just a money management app, it's a lifestyle by design app, because it covers money smarts, but also covers wealth, and it covers property, and it covers all of your finances in one spot. So it's not an app that's competing with other finance apps, Ben. It's an app that we hope occupies a unique space around that whole lifestyle design, which has those 4 pillars. So there you go, folks. That's my life hack today. Have you compared your working income speed to your passive income speed in MOOR? Because it certainly encourages you to do that, and it brings a lot of stuff to focus. What's making property news today?
And I've got a couple of things to talk about. First one is the 9 News. They did a report which I also featured in and got some commentary as the chair of Picker. And it talks about Steve, who's got 12 investment properties in his 70s, and he's really struggling in terms of, with the increases, the debt that he still has on those properties. Now, 12 properties, well, yes, obviously that can be challenging if he hasn't been able to pay off those properties. So he's going to have to do a portfolio rebalancing, is what we would call that, as part of the story. But for me, it just also highlights the story that in certain instances, there are cases where some landlords are going to have to put their rents up as much as possible because they've had a significant increase in terms of their cost of holding their property. In other cases, there might be examples where there's really strong passive income coming off certain properties, and the landlord might be a little bit more generous in terms of what they can do around their current situation as well. So unfortunately, that is a case-by-case situation. And of course, to some landlords' benefit, they are not putting their rates up or their rents up as high as they possibly could because they're in that fortunate position. So, but in other cases, you're talking about, significant tens of thousands of dollars an increase in holding costs, and they're only recouping maybe 5 or 10% of those costs attached to that. So, that sort of makes mention in that particular story as well. So that's the first of what's making property news, Bros.
Yeah, so we'll have a link in the show notes if you want to check that out. I mean, it is, when someone has 12 properties, some people just go boo-hoo. But the point is that we always talk about you just probably need 3 to 5 good ones. Ideally, by the time you get to your 70s, you've retired out the debt, so you're not in the same position that Steve finds himself in. But ultimately, landlords are people too. And for a lot of the anecdotes that we've talked about over the journey on this podcast, the idea that it's big fat cats is a myth, because it's people trying to self-fund. And in that article, it talks about the fact that it's not entitled to any government support, given the fact that their assets are too high. Yeah. That's the game. Like, the fact that people see the pension in this country as something that they use as the what they'll get in retirement, whereas we're saying no, it should be like when you're doing when you're at the circus and you see someone doing an act on the trapeze and they're doing backflips and somersaults and all that, and then the next person has to catch them, the safety net is only there on the odd chance that they miss. People need to see the pension exactly the same way. You try and have a swing to be self-funded and self-supported yourself, and the pension needs to be the base. But in this case, Steve's having a swing for whatever reason in their 70s, not in control of the debt story, and we don't know who Steve is. It's actually a pseudonym. It's is that the right word? Alias. No, that's an alias. Sorry,
alias. Yep,
not his real name. But trying to self-fund, and he's a human who has costs, who needs to pass it on, and is not getting all of those costs reimbursed as well. So important anecdotes, I think, to have in the conversation around greedy property investors. What else have you got in the perception for greedy property investors? What else have you got, Ben?
Well, that would be remiss of me not to talk about the biggest economic event that sort of occurred in the last 6 to 12 months outside of COVID, and that was a run on two US banks that both went into liquidation last week and over the weekend before the Fed effectively bailed out the deposit holders there. But I'm talking the main one, which was a top 20 bank, which was Silicon Valley Bank. And so that could have had a more severe consequence than it currently did. But it really has highlighted that the risks in the US market around the level of interest rate rises and the way in which they manage risk in terms of their banking system over there. So that would have had certainly contagion or ripple effects that may have occurred in other countries. Australia, we had obviously, so Silicon Valley Bank is very much a tech startup and tech supported bank, hence the name. And so we had a couple of obviously Australian fintechs and prop techs and technology and innovation businesses caught up in that, but they now know that their deposits are safe and they'll be getting access to that money. But it has highlighted now that the challenge for the Fed over in the US is how quickly and how much more aggressively do they raise rates. And what's interesting about what's happened here, Bryce, is that the money markets have suggested now there's around a 79% chance that the RBA will now pause rates coming into its April meeting. Now, there's still a little bit of data that needs to be had. So this is the market trying to predict the latest thing that's happening. And so we still have unemployment to be read. So that number's worse than expected. That also is an argument for a pause. Consumer spending, we'll start to see some of the data coming through from the banks in terms of how much slowdown we're seeing in consumer spending. We've got the first batch of big fixed rates coming off in April as well. So the RBA has got to have that under consideration. And finally, what's happening from business confidence and business performance point of view. So those data points still need to be read. But I weave this into the mid-month results we're getting through from CoreLogic and the hedonic index around property prices, Bryson. There is green shoots in here, and this could be an interesting story, right? We're seeing the weekly change in Sydney plus 0.03 of 1%, Melbourne plus 0.3, Brisbane plus 1, Adelaide flat, Perth plus 0.1, and the combined capitals are now 0.2% higher for the week. And then the monthly change, you're seeing Sydney plus 0.6 of 1%, Melbourne plus 0.1, Brisbane still negative, Adelaide still negative, Perth positive. So combined capitals plus 0.3 for the month. So what is that telling you about the market? Well, we're starting to find a little bit of balance in the market. Now, what would that mean? Are we calling the bottom yet? No, I think that would be premature in terms of calling the bottom. But what it is saying is we're moving more towards that balanced market, which comes back to our thesis that Bryce and I presented a couple of weeks back about where we saw the cash rate. So we said if the cash rate still remains around 3.6 and we see a pause and we want to guarantee the bottom, then, banking on this idea that we might only see another 0.5% or 1% correction in property prices, you may be in a position to act now, or you should be looking at the market in terms of those opportunities. Now, so I sort of say the bottom is around a 30% probability where it currently sits. But if we do see a pause, that moves up to at least 50%. And then if there's no further increases, then that moves up to around 70% in my books in terms of that. And then it's just about how long inflation remains persistently high to see. Now, if that inflation story starts coming down and interest rates come off these peaks, then all of a sudden we'll start to see some momentum come back into the property market. And we would have judged that the bottom of the market was actually this time in 2023. So it's still an interesting time. We're not calling the bottom yet, but we're quite interested in terms of what's going to be happening over the next couple of months, because it's getting very, very close, Bryce.
It is getting very, very close. So interesting feedback there, and interesting, as you say, to see the green shoots. And we also said back then, Ben, that it takes a bit of time to get into the property market. So, if you haven't factored that in, now if you're in a position now might be a good opportunity. So very good. All right, so we've had a fair bit covered in that episode. Again, thanks to our special guest Julia for actually joining us on the couch, Ben, which was incredible. For those of you that listen to this and you want to listen to that again, you can go to our YouTube channel, the Property Couch YouTube channel, because we did this also as a video version of this podcast, Ben. So for anyone who wants to see that, what that looked like for us in the studio, and the incredible work that our team does to pull that together, they can go and check that out. But mate, until next week.
Knowledge is empowering, Bryce, but only if you act on it.
Act on it. Well said. See you next week, folks.